Hello comrades, it's the Finnish Bolshevik. Let's continue our political economy series, shall we? Last time we talked about turnover. This time let's talk about the rate of profit. The surplus value created by labor is the source from where all exploiting classes in capitalism get their income. That's where they all get their profits. There are several kinds of capitalists. There's merchant capitalists, bankers, landlords. But the most typical and the most important in capitalism is, of course, the industrial capitalist or the capitalist who invests in production. So that's what we're going to examine today. So what determines the rate of profit of that guy? The value of a commodity produced in a capitalist enterprise breaks down into three parts. One, the value of constant capital. So that part of the value which is in the machinery and buildings, the value of raw materials, fuel, etc., part of which gets embodied or transmitted into the product, the fuel that's consumed, the raw materials that are consumed in making the product, and also the wear and tear on the machines, they all transmit some of their value into the new product. Two, the value of the variable capital, so the amount of value that is paid in wages. And three, surplus value, which of course is also created by labor, but it's separated from variable capital in this because surplus value is in a way not paid for. Surplus value is the value that the labor produces above and beyond what is compensated by the wages. The magnitude of a commodity's value is determined by the amount of socially necessary labor required for producing it. The capitalist's cost of production of a commodity consists of the outlay of constant and variable capital, so C plus V. In other words, the expenditure on means of production and on wages. The cost of the commodity to the capitalist is measured by the outlay of capital, while its cost to society is measured by the outlay of labor. Therefore, the capitalist costs of production of a commodity are less than its value, or less than the real cost of its production, which is C plus V plus S, or constant capital, variable capital, and surplus value. The difference between value, or real cost of production, and capitalist cost of production is equal to the surplus value, which the capitalist appropriates without compensation. This is something that we've talked about extensively already, so I'm not going to go deeply into it anymore. When the capitalist sells a commodity which has been produced in his enterprise, then surplus value appears as a definite surplus that's over and above the capitalist's cost of production. The capitalist can then set this surplus against the capital which he has advanced, or the capital that he has invested into production, to determine his rate of profit. So surplus value placed in relation to total capital is the rate of profit. There's a tricky thing here which confuses most capitalist economists, and I believe that especially nowadays it is intentional, because in trying to figure out how much the profit is, the surplus value is not compared just with variable capital, because the rate of surplus value would be variable capital compared to surplus value, or basically necessary labor time versus surplus labor time. But in determining the rate of profit, the surplus value is compared to variable and constant capital both, and as a result, the deceptive appearance is created that profit is created by the capital itself. Most capitalist economists, they claim that value is created by both labor and capital, which of course is false. The capital does not create any value. So just like paying wages conceals exploitation, it makes it seem like the value created by the labor is fully compensated for, even though it's not. Wages don't compensate for surplus labor, only necessary labor. In a similar way, the form of profit hides the fact that the value is created only by variable capital, making it seem like constant capital also, at least potentially, could be creating value. And when we look more deeply into it, it's easy to understand why somebody could think that, because a capitalist could get more profit by just investing more constant capital. Although, of course, the rate of profit and the total volume of profit are different things. But anyway, let's examine this a bit further. The degree of profitability of a capitalist enterprise for its owner is determined by the rate of profit. The rate of profit is basically the proportion between surplus value and total capital invested, expressed as a percentage. For example, if the total capital invested is $200,000 and the yearly profit is $40,000, Now keep in mind, this is profit, this is not revenue. Revenue would be way more, but this is profit that's left after all the expenses are paid for. Then in that case, the rate of profit would be 40,000 divided by 200,000 times 100, or 20%, which is quite good. Another relation that's worth pointing out is that inasmuch as the total capital invested is greater than variable capital, the rate of profit is less than the rate of surplus value. Suppose, for example, that the previously mentioned $200,000 of capital consists of $160,000 of constant capital and $40,000 of variable capital. Then in that case, the rate of surplus would be 40,000 divided by 40,000 times 100, or 100%, but the rate of profit is only 1/5 of that. And that's because the rate of surplus value is just surplus value contrasted with variable capital, but the rate of profit is surplus value contrasted both with constant and variable capital. Now this is already kind of hinting at the cause of the tendency of the rate of profit to fall, which I will discuss at the end. However, the rate of profit still, first of all, depends on the rate of surplus value. The higher the rate of the surplus value, the higher, other things being equal, would be the rate of profit. All the factors which increase the rate of surplus value, in other words, all the factors that raise the degree of exploitation of labor, such as lengthening the working day, raising the intensity and speed of the labor, raising the productivity of labor, they all increase the rate of profit. Further, the rate of profit depends on the organic composition of capital. As we've discussed previously, organic composition of capital is the proportion between constant and variable capital, so how much labor power there is versus how many machines you have. The lower the organic composition of capital, in other words, the more labor power you have in contrast to machines, the larger will be the rate of profit, assuming that the rate of surplus value is the same. And vice versa, the higher the organic composition of capital, the lower the rate of profit. So basically, assuming that the exploitation and productivity and all those things of the labor are the same, the more labor power you employ compared to how much constant capital or means of productions you have, the higher the rate of profit. The more mechanized the work is, the less profitable it is. That may seem very unintuitive, may seem like the total opposite of what the capitalists themselves think, what capitalist economists say, but it is true nonetheless, and I will explain later why that is. Now, furthermore, the rapidity of turnover of capital, which we talked about last time, also affects the rate of profit. So, the more rapid the turnover of capital, the higher the annual rate of profit. Not necessarily the rate of profit per operation or per unit or anything, but if we're talking about time-wise, then if you can do it faster, then at the end of the year, you'll have more profit. Then let's talk about the formation of the average rate of profit and transformation of the value of commodities into their prices of production. Not all capital is the same, not even all productive capital is the same. There are different kinds of branches of production. There's agricultural production, textile manufacture, there's metal manufacture. The capital of a given economy at a given time is always distributed somehow between the different branches. The competition within a branch means that enterprises that produce the same kind of commodities, let's say boots, they compete against each other. They try to make their boots cheaper to produce, cheaper for the customer so that they can get more customers, try to make them look better, try to increase the exploitation of their workers, try to use economies of scale. There might be a small boot producer who can't produce as effectively as somebody with a bigger factory or a bigger chain of factories. So the individual values of the boots produced by different companies are not the same. In one company, it might take on average an hour to produce X amount of boots, and in another 50 minutes. But of course, the value is really determined by the social average. So the value of the commodities concerned depends on the average conditions of production in the particular branch. Those companies in the branch who produce more efficiently than average, they get super profits. We've talked about this before. And those who produce less efficiently than average, they lose out. So inside the same branch, different enterprises have different rates of profit. So they're all chasing the super profits, which they get usually by improving the productive forces. First, one company introduces a better machine, they get super profits because they produce more efficiently. But then all the competitors, they also introduce that same innovation. So then the super profits become negated because now everybody is using the same innovation. The guys who were getting super profits, well, now they're not producing any more efficiently than anybody else. So the super profits are always temporary, but all the capitalists are chasing them. As a result of this fact, which is created by competition, the amount of means of production, the amount of machinery increases, the organic composition of capital in this branch increases over time, which actually causes the rate of profit on average to go down for the whole branch long term. But typically, none of the capitalists think about that because they don't care about the whole branch. They care about their own company. They care about their profits. And I would imagine that especially if you're just an investor, what do you care? You can take your money somewhere else. If this boot production thing starts producing lower profits, just migrate your capital to a different branch. So that's competition within a branch. Competition between branches means competing which branch is the most profitable way of investing capital. The capitals invested in different branches of production have different organic compositions. Those branches which have a lower organic composition of capital, i.e. more labor and less machinery, they have a higher rate of profit, relatively more surplus value compared to the amount of total capital. However, in the long term, the rate of profit between the different branches tends to equalize. Let's suppose that in this economy there's 3 different branches of production. There's leatherworking, textiles, and engineering. And the capitals in each are the same size, but different in organic composition. Let's say each capital is $100 million. The capital of the leatherworking branch consists of 70 units of constant capital and 30 units of variable. In the textile branch, there's 80 units of constant and 20 of variable. And in the engineering branch, there's 90 units of constant and 10 of variable. Let's also assume that they all exploit their workers just the same. So say that the rate of surplus value is 100% for all of them. Again, this is not always a given because different kinds of workers have different kinds of labor contracts. Some of them have stronger unions, etc., etc. In some branches, they use immigrants who have less rights, so on and so forth. But for the sake of explanation, let's assume that they all have the same kinds of labor conditions and whatnot. So in that case, the leatherworking branch produces 30 units of surplus value, the textile branch 20, and the engineering only 10. The value of the commodities in the first branch will be 130, in the second 120, and in the third 110. 360 in total. If the commodities are sold at their values, then in the leatherworking branch the rate of profit will be 30%, in the textile 20%, and in engineering 10%. Again, there could be a complication. Let's say somebody has a monopoly, or let's say that there's some kind of international glut of textile goods or something, which could temporarily lower the value, or say that there's an international shortage of leather goods, then the leather products could be sold above their value, but whatever. Of course, in this situation, it would be most advantageous for a capitalist to be investing into leatherworking and pretty bad to be investing into engineering. So in this situation, capital will begin to flow from engineering into leather production. All the capitalists think, well, this branch sucks. Let's go to that branch where everybody is getting money hand over fist. They're getting crazy profits. Let's go there. What that means in practice is that they're all investing into leather production, so more leather is being produced. There's more leather going around, competing for the same customers. This more intense competition will lead to the price going down, will lead to attempts to produce more efficiently by introducing more machinery. As a result, there will be a reduction in the rate of profit in the whole leatherworking industry. At the same time, in the engineering branch, the quantity of commodities will be reduced because capital is fleeing from that branch, and the change relationship between supply and demand will actually cause the rate of profit to rise in the engineering branch. So the fall in the price of the leather goods and the rise in the price of the engineering goods will continue until the rate of profit in all the 3 branches becomes approximately the same. I'm sure you can understand why. As long as the profits in the leatherworking industry are higher, which will cause the profits to go down in that branch and the profits to go up in the other branches until they're all equalized. So at the end, the commodities of all the different branches will be sold at 120 instead of 130, 120, and 110. The average profit of each will then be 20 units. The average profit of a society means an equal profit on all capitals of the same size invested in different branches. It should also be said that, of course, the flow of capital is not only flow of money, but is also flow of labor power, because, think about it, if all the textile shops close down and all those capitalists invest into, say, weapons manufacture, well, a lot of those workers that have been laid off, they'll need to now go and work in the weapons manufacturing. The price of a commodity in any of the branches is composed of the cost of production, in this case 100 units, and the average profit, 20 units. The price, which equals the cost of production of a commodity plus the average profit, is the price of production. Why is the cost of production 100 units? Because the different branches on average, they have 80 units of constant capital and 20 units of variable capital. Those are their costs. That's 100 in total. That plus the average profit of 20, and you get the average price of production. In different companies in the same branch, there exist differences in the individual price of production, which are determined by the individual cost of production plus the average profit. However, the commodities are realized or sold at an average uniform price of production. The process of formation of an average rate of profit and price of production is shown in this useful table. So here you can see that the leatherworking branch initially had more variable capital. It got more surplus value as a result. The value of the commodity was higher as a result. The average rate of profit was higher as a result. But then, because everybody went into that branch, the prices eventually came down. So then the price of production is 10 units below its value, so it still results in 120. And likewise in engineering, they had less variable capital, less surplus value. Value was lower, rate of profit was lower. But then in the end, because of the resulting shortage, because all the capital left that branch, the ones who remained were able to sell 10 units above value. The transformation of value into price of production is a result of the historical development of capitalist production. Under conditions of simple commodity production, the market price of commodities in general correspond to their values. In the first stages of capitalism's development, significant differences were still retained between the rates of profit in different branches of production, since the separate branches were as yet insufficiently interconnected, and craft and other restrictions existed, which hindered the free flow of capital from some branches to others. The process of forming the average rate of profit and transforming value into the price of production was brought to completion only with the triumph of capitalist machine industry. With the transformation of value into price of production, the basic economic law of capitalism, the law of surplus value, becomes concrete and finds expression in the form of the average rate of profit. The law of surplus value meaning that what makes the economy go around is all the capitalists trying to get more surplus value, and its concrete expression is the average rate of profit. The Soviet textbook we're using points out that bourgeois economists try to refute Marxist labor theory of value by saying that in some particular branch of production, the price of production does not coincide with the value of the commodities, but that's just because the price of production is a modified form of value. The price, as I'm sure you know by now, never precisely corresponds to the value, because there's always either too many or too few products. Some of them are always sold below or above their value. On the scale of the society as a whole, however, it matches perfectly. Some sell above value, some sell under value, somebody pays too little, somebody pays too much, it all evens out. And all these things, like if some capitalists get super profits, it causes the profits to eventually even out. Or if some branch is more profitable, it still leads to the branches evening out in the end. However, all these fluctuations and equalizations, they further disguise what is actually happening and make this situation more difficult to analyze and more difficult to see that it's only labor that creates value and that it's created by exploitation. The formation of an average rate of profit means a redistribution of surplus value among the capitalists in different branches of production. part of the surplus value created in the branches with a low organic composition of capital, in other words, those that are more profitable, is actually appropriated by capitalists in branches with a high composition of capital, which are less profitable. Therefore, the workers are actually not only exploited by those capitalists for whom they work, but by the entire capitalist class. If part of the value that is appropriated by the capitalists you work for, if it still goes to also other capitalists, then it's really them all as a group that are exploiting you. And furthermore, the entire capitalist class, despite all their competition and whatnot, they all have an interest in raising the degree of exploitation because it leads to a rise in the average rate of profit for all of them. So the average rate of profit, on the one hand, it expresses competition between different kinds of capitalists, but it also expresses the unity of all the capitalists against the workers, and the basic antagonism between the workers and the capitalists. Then let's talk about the tendency of the rate of profit to fall. By now, you may already have a sense of what causes the tendency of the rate of profit to fall. As capitalism develops, the organic composition of capital steadily increases, because all the different capitalists are trying to implement innovation so that they can get super profits. But then when everybody does it, it cancels out, and you just end up with more constant capital and less variable capital in relation. So let's use our previous example. The sum total of all the capitals that we had in the previous example is 300 units, which consists of 240 units of constant and 60 units of variable capital. With the rate of surplus value at 100%, 60 units of surplus value are produced, and the rate of profit is 20%. Let's then suppose that during 20 years, the total amount of capital grows from 300 to 500 units. At the same time, as a result of the progress of technique, the organic composition of capital grows. Consequently, the 500 units of capital are divided into 425 units of constant and 75 of variable capital. The amount of machines has increased tremendously. The amount of laborers has also increased somewhat, but not nearly as much. Given the previous rate of surplus value, 75 units of surplus value will be created. The rate of profit will now be 75 divided by 500 times 100, which equals 15%. The amount of profit has grown from 60 to 75, but the rate of profit has fallen from 20% to 15%. So a rise in the organic composition of capital leads to a lowering of the average rate of profit. In this example, we have 3 different branches of production. So this is talking about the average rate of profit. It's not even talking about the profit of a single company. All that being the case, there are a number of things that can counteract the lowering of the rate of profit. And of course, the capitalists would like to use all of these. First of all, it's possible to increase the exploitation of the working class. The development of the productive forces, while it leads to an increase in the organic composition of capital, it also at the same time leads to an increase in the rate of surplus value. Now, this is quite paradoxical, but if you think about it, basically it means that on the one hand, you have less variable capital compared to constant capital, but then again, the variable capital is divided into necessary labor and surplus labor, and the amount of necessary labor diminishes. The worker is able to produce the necessary labor in a much shorter time, increasing the surplus labor time. So although the rate of profit does go down, it goes down slower than you might otherwise expect. Also, machines can be used to replace workers, which can increase unemployment, which lowers wages and increases profits. Thirdly, as the productivity of labor grows, there is a fall in the value of the means of production, machinery, equipment, raw material, etc., and this slows down the growth of the organic composition of capital and partially counteracts the lowering of the rate of profit. Think about it like this. The organic composition of capital refers to how much of the value is variable capital versus constant capital. It doesn't actually refer to how many workers you have versus how many machines, how many tractors, how many lathes, or whatever. Technical composition of capital refers to the literal machines, but organic composition refers to just the capital. So you can increase the amount of the machinery by a huge amount, but if the value of the machinery falls, then the increase in constant capital isn't actually as much as you would imagine. You can get a crazy amount of new machines, but if they're almost valueless, then they increase the constant capital only slightly. So let's suppose that an employer has his worker who used to be operating 5 machines, now he has to operate 20 machines. So potentially a huge increase in constant capital, a huge increase in the organic composition of capital, but as a result of the growth of productivity in machine-making industries, the value of the machines themselves falls by half, and consequently, the number of machines was quadrupled, but the new machines are not worth 4 times as much as the previous situation, they're only worth twice as much. So the share of constant capital grows twofold, but not fourfold. Fourthly, the lowering of the average rate of profit is counteracted by economy in constant capital affected by the capitalists at the expense of the health and lives of the workers. This means worsening the working conditions, basically cutting costs on safety. Of course, in developed imperialist countries, there are laws against this, but the capitalists, of course, they tend to move their factories more and more to the third world countries. And even in the imperialist countries, they use migrant labor and they break laws, so they're able to make the working conditions worse to save money. Fifthly, the textbook says that the fall in the rate of profit is also hindered because of unequivalent exchange, which exists in the sphere of foreign trade, when capitalists in the imperialist countries sell their commodities to oppressed countries, colonies, semi-colonies, and economically reliant countries at exorbitant prices and obtain super profits. Basically a value transfer from the poorest countries to the richer countries. All of these factors do not prevent or abolish the lowering of the rate of profit, but they merely weaken it. That's why it's only a tendency. It's a tendency that unavoidably is part of capitalism, but it's not something that happens quickly or extremely consistently. There can be ups and downs, zigs and zags. Capitalism has been in a general crisis for 100 years at least. There's been periods when the crisis has been more severe. The Great Depression, the 1970s depression, 2008 financial collapse, the recession we had during the pandemic. The rate of profit and rates of economic growth during those periods have been extremely low. Oftentimes you've even had negative growth. But the capitalists have implemented policies to try to negate the situation. To respond to the 1970s crisis, they implemented neoliberalism. To counteract the 1990s and 2008 crises, they implemented huge austerity measures, so on and so forth. It hasn't solved the problem, but it's given capitalism temporarily more life expectancy. The fall in the rate of profit also does not mean a reduction in the amount of profit, that is, the total volume of surplus value. On the contrary, the amount of profit grows both in connection with the rise in the rate of surplus value and as a result in the growth of the number of workers. And this is something that critics of Marxism oftentimes don't understand. When they hear Marxists talking about the tendency of the rate of profit to fall, they immediately respond by saying, well, look at these companies, they're making big profits. The total volume of profit is not the same as the rate of profit. Of course, the total profits these days are bigger than probably at any time in history. The companies are also bigger. You would expect a larger total volume if the companies themselves are larger, if the economies themselves are larger, if capitalism is more widespread than before, etc. The textbook says that capitalists try by intensifying to the utmost the exploitation of the working class to weaken the tendency of the rate of profit to fall. This leads to the contradiction between the proletariat and bourgeoisie becoming more acute. In their drive for higher profits, the capitalists invest their capital into backward countries where working hands are cheaper and the organic composition of capital is lower than in countries with highly developed industry. And they begin to exploit the peoples of these countries intensively. This leads to a sharpening of the contradictions between the developed capitalist countries and the backward ones, between metropolitan countries and colonies." Unquote. Even though this book is from the 1950s, that is extremely relevant to our day as well.